All right, welcome to The Explainer. This is where we take big, complex topics and we break them down, using the source material to guide us. Okay, so here's a question for you. Why are people who are so into this brand new, cutting-edge technology totally obsessed with a century-old economic theory? I mean, it seems kind of weird, right? You've got Bitcoin on one side and the Austrian School of Economics on the other. Today, we're going to dig into that powerful and honestly, pretty surprising connection between the two.
So to really get why these two worlds collide, we've got to go back to the beginning. We need to understand the economic school of thought itself. Where did this all start?
So get this, the name Austrian School, it was actually meant as an insult. Yeah, seriously. According to economist Peter St. Onge, the term was basically invented by state-sponsored German economists to make fun of these ideas, like they were from some backwater province. But hey, the name stuck. And now, its followers see it as the original form of economics, before governments got their hands all over it.
And that right there, that's our first big clue. At its very core, it's about being deeply skeptical of central authority, of government competence, of their motives. And that should sound really familiar, because it's the exact same spirit that fuels the whole Bitcoin ethos of don't trust, verify.
Okay, so this is where things get really interesting. The huge disagreement between the Austrian school and, say, the more mainstream Keynesian view, it all comes down to one simple but absolutely massive question. What is money anyway?
In the Austrian view, money isn't some magical thing created by the government. Nope, it's a tool. It's a technology that just sort of emerges naturally from the market to solve a couple of really basic problems. Like, how do I trade with someone who doesn't want the thing I have? And how do I save the value I create for later? It's just a good, like any other good.
And this slide just lays it out perfectly. You've got two totally different ways of looking at money. Is it a tool that comes from the ground up for the people with its value discovered by us? Or is it a lever from the top down, a tool for the government to pull and push to achieve its own policy goals? I mean, you can't really get more opposite than that.
And here's the kicker. In the Austrian view, prices are truth. They're signals that tell us what's valuable, what's scarce. They guide everything we do. So if you accept that, then messing with money from the top is like messing with the entire nervous system of the economy. You're distorting all those truthful signals, and that just causes people and businesses to make really bad decisions.
All right, let's talk about something we all feel. That constant lurch from boom to bust, right? That feeling of instability in the economy. Ever wonder where that comes from? Well, the Austrian school has a pretty controversial answer, and it points the finger squarely at central banks.
So, according to this theory, the whole boom and bust cycle we think is normal, it's not a feature of capitalism, it's a bug introduced by central bank intervention. It goes like this. The central bank makes money artificially cheap, easy money. Businesses then borrow that cheap money and build stuff that isn't actually profitable on its own. They call this malinvestment. This creates a fake boom. St. Onge calls it a tissue fire, which is a great image. It burns super bright, but it's gone in a flash. Because eventually, to fight the inflation this causes, the central bank has to raise interest rates. And when they do, poof, all those bad investments are exposed, and you get the bust.
And this is a really intense analogy from St. Onge. He says a government that just lives on taxes is like a parasite. It needs its host, that's us, the economy, to stay pretty healthy so it can keep feeding. But a government that can just print money, that government turns from a parasite into a predator. It doesn't need a healthy host anymore. It can just drain resources whenever it wants, even if it kills the very economy it's supposed to serve.
Okay, so if we accept the argument that centrally controlled money is the problem, then what's the fix? Well, for hundreds of years, the answer was always gold. But now, in our digital world, a whole new contender has stepped into the ring.
And this is where Bitcoin comes crashing into the story. It's seen by its supporters as the digital heir to gold. It takes all the things that made gold good, hard money, it's scarce, it's outside government control, and basically supercharges them for the 21st century. It can be sent anywhere instantly, its supply is absolutely finite, and because it's decentralized, it's just incredibly hard for anyone to seize or shut down.
So, you might be asking, well, if gold was so great, why don't we use it anymore? The argument here is that gold has a fatal flaw. It's physical. You can't email gold bars. To make it work for a big economy, you have to pile it all up in central vaults. And what happens when you centralize something valuable?
It becomes a giant, juicy target for governments. It's just too tempting for them to go back on their word and grab it. And history shows that's exactly what they did, over and over again.
Okay, so let's zoom out. What's the end game here? What would a world actually running on hard money like Bitcoin even look like? Because according to this worldview, it's not just about changing our currency. It's about changing, well, everything.
The vision is honestly huge. Proponents argue that without a money printer, governments would have to shrink. Wars would be harder to fund. The boom-bust cycle could end, and normal people could actually save their money without being forced to become stock market gamblers just to keep up with inflation. It's a call for a massive cultural shift back towards long-term thinking. Now, of course, critics will jump in here and say, hold on a second. They point to Bitcoin's crazy price swings or the fact that the network can get slow and argue that it's just not practical for a modern economy.
And that brings us to a really fascinating cultural point. The argument is that easy money doesn't just mess with prices, it messes with our values. It rewards short-term, reckless behavior over long-term solid value creation. Think about it. This theory suggests that's why the image of a banker went from this prudent, conservative guy in the 19th century to the whole Wolf of Wall Street stereotype we have today. When money is cheap, the system rewards the gambler, not the saver.
So in the end, that's what this all boils down to. Two completely different blueprints for the future. Are we better off with a system that's managed from the top down, with the flexibility of government money, or is the path forward through bottom-up decentralized principles and the hard certainty of something like Bitcoin? It really is the big question, and the path we choose will define the world you and I live in for decades to come.